So hi guys, welcome back. Today we'll be looking at Canadian Solar, ticker symbol CSIQ, and we're going to be doing a stock analysis on this video. I believe that Canadian Solar is a good, strong solar growth stock, and it's trading at much cheaper valuations compared to many of its competitors, making it a good financial investment. I believe that this company is a standout energy stock in an industry where everything is grossly overvalued and overpriced. This stock offers both growth potential and value together, and that's why I believe that it's a good investment. We'll be going through this PowerPoint presentation, and I will be looking at why I believe it's a good investment. So just before we begin, a little bit about the company. CSIQ is a solar company. It operates in two major business segments, the MSS segment and the energy segment. The MSS segment involves in the design, the development, and manufacturing of solar power products, and the energy segment consists of solar project power development and the sale of developmental services. So the main two things it does is manufacture solar PV models, which is the MSS part of its business, and then the energy part of business runs large-scale solar products. It has a ZAX rank of 2, which is a buy, and most analysts also say that this company is a strong buy to go with. It's the leading manufacturer of solar photovoltaic modules and the provider of solar energy solutions. And as already mentioned, it operates in two segments, the module system solutions, or MSS, which is mainly the semiconductor part of the company, and then the energy, which is the production part of this company. When we compare it to competitors and its industry, we'll be looking at it through a semiconductor industry, as that is the primary focus of this company. Canadian Solar has also delivered more than 52 gigawatts of solar modules to thousands of customers in more than 150 companies through the end of 2020. And as I mentioned at the beginning of this video, this company has no specific competitive advantage, but I believe it's still a good will give you a good return on investment because it's trading at much cheaper than competitors, and it also has a better valuation than most of them, while still giving you the growth aspect as well. So just before we begin, I'll quickly go through this financial analysis. The earnings per share was pretty shaky at the beginning, but over the past few years consistently growing, so that's good. Book value per share, same story, shaky at the beginning, consistently growing since then, once again good. Its operating cash flow, cap spending, and free cash flow has all been increasing, basically showing that they're making more money, spending more money, and keeping more money, all three of them showing good trends for a growing company. And moreover that, it shows that it has a healthy cash flow statement and will continue to have a healthy cash flow statement in the future. Its net margin is low because it runs a very capital intensive business model, but still positive, so it's not terrible. Return on equity is a bit shaky, but consistently between the 10 and 15%, so the return on equity is also pretty solid. The interest coverage is pretty low, but a 4-year interest coverage is not terrible, but it could be higher, so once again, not amazing, not terrible. But they have been pretty conservative with their debt, only having a debt-to-equity ratio of 0.57, which is pretty good for a company that gives you very, very good growth prospects. Its PE ratio of 18, although has been growing very, very fast in recent times, shows it's still much more it's much cheaper than both competitors and the market as a whole, and its PEG ratio of 0.7, showing that this company is growing very fast. So having low PE and a low PEG basically shows that the company is trading at cheap and growing fast, which is a good combination to have. So now we'll be looking at comparisons. As I mentioned, the PE ratio is better than the industry and the market. The PEG ratio is showing good current and future growth. The PB ratio of 2.5 is better than the industry, but is not enough to be an asset play, so you wouldn't want it to be something like a bank or something. Now coming on to the growth, the earnings per share growth of 27% clearly outperforms the industry and the market in the next year or so. The revenue growth of 22% also performs better than the industry and the market, showing that this will clearly outperform both the industry and the market over the short and long term, which is a good sign to have. The fact that the earnings per share is growing faster than revenue, basically showing that the company is will have better use of money in the future, and a price to sales ratio below 1 shows that the company is priced pretty attractively based on the sales that they're making. As more and more companies focus towards renewable energy, this stock will this stock will definitely benefit because it's trading at cheaper, and you as an investor will get a higher return on investment because you're buying cheaper and receiving the same growth. So now we'll be looking at the technical analysis. We can see over the course of the year, it went from about $20 to $63 now. During this time, they had two ceilings, one at $44, one at $56. Recently, the stock price has gone up quite rapidly over the past few weeks, causing it to break past the $56 mark. But there isn't enough trend past the $56 mark to basically show that the stock price will continue shooting up from there. So I would give it a buy if you do choose to invest at $56, or if you're being slightly more conservative, $48, which is the 50-day simple moving average. So just some final words about this company. It has good valuations. It has better growth than the industry and the market, and is very good growth compared to its competitors. It has good future growth and has a decent price point. Is a little bit expensive based on the recent breakout, but overall is still priced pretty attractively with a PE ratio of 18 and a PEG ratio of 0.7 and a price to sales ratio of below 1. Overall, it's a good stock, but as I mentioned, it has no competitive advantage. Simply a good investment because it is cheaper than competitors. So, but as always, do your own due diligence. Thanks for watching, and I'll see you in the next one. Bye.